Happy Forgings and what the outlook is for the company going ahead and what the company plans to do with the IPO proceeds. A very good afternoon to you, Mr. Ashish Garg. Thank you so much for joining us on ET9. Ashish Garg is the Managing Director at Happy Forgings. Let's talk about your IPO firstly, and wanted to understand about your business process, and also what do you plan to do with the funds that you will actually raise with the IPO?
Thank you so much for this conversation. So I'm the Managing Director of the company. We are into forging and machining business, and the machining business today forms almost 85% of our revenue. And we are majorly into heavy forging of the components and heavy machining of the product range, catering to commercial vehicle, off-highway, farm equipment, as well as industrial sectors. And the IPO proceeds, we have planned 400 crores of fresh issue and 600 crores of OFS. And the 400 crores of primary fundraising. Out of this, approximately 150 crores is planned for the capex, and balance for the repayment of debt and general corporate purposes. And so this is in addition to the regular capex that company is doing. So company is doing almost 70% of the total cash accruals is normally deployed every year in the capex. So this year capex is around 200 crores. Next year projected capex is around 300 crores, and the primary fundraising will also help us in boosting our capex.
Okay. Given that you primarily serve to commercial vehicles, now the demand for CVs are expected to rise going forward. What is the kind of growth that you are expecting for your business?
So typically, in the last 5 years or in the last 10-year scenario, company has grown at a CAGR of 18-19% in terms of top line, including COVID years, and EBITDA has grown at a CAGR of 24-25%. So going forward, we see that we'll be able to maintain this growth trajectory going forward. With the primary fundraising coming in the company, we can accelerate this growth. So it's CV is almost 35-40% of our revenue. We have farm equipment, off-highway, and industrial as well. Industrial has picked up in the first 6 months of this year. We have already touched 13.5% revenues coming from industrial. And so if you look at the CV has gone to 38-40% this year because of the increase in the industrial business. So that's how the business is for us, and going forward we see all the sectors doing well.
If you see your margins, they have remained largely stable over FY21 to FY23, around the 27 to 28% band. Is there any scope for expansion going forward?
So yes, last couple of years, last 2-3 years, we have seen rise in the raw material prices, even though raw material prices are complete pass-through for us. Because of the incremental raw material prices, we see slight dip in the EBITDA margin, even though the last 5 years, the EBITDA is around 27%, including the COVID year. Going forward, we see its range bound between 29 to 30%. So H1 for us is around 29%.
All right. Let's move on then, and let's actually talk about your expansion plans going ahead, and also what sort of a growth are you envisaging when it comes to your businesses?
So as already explained, that 70% of the cash we are deploying in the business every year. So the last 4 years, we have doubled our gross block, investing over 600 crores in the business. So going forward, we see, a similar set around 60 to 70% of the total cash will be deployed in the business, along with the primary fundraising. So in terms, we are looking at spending over 900 crores in capex in the next 3 years.
So if we see exports were in single digit earlier in FY21, now the contribution has increased around 13% in FY23. Will export market be the major focus going forward for the company?
Yes, exports have already risen to 21% in H1 for us from 13.5%. And going forward as well, we see strong growth momentum in exports. 60% of the new businesses which are in pipeline are coming from exports. So definitely this 20% exports will touch around 25-30% going forward in next 12 to 15 months. Even the indirect exports are around 11%. Over there also we are seeing a strong traction.
Now, sir, lastly, if you see over FY21 to FY23, your revenue, EBITDA and PAT have grown at a CAGR of around 43 to 55%. Your ROCs have improved from 14% to 22% in FY23, while ROEs have improved from 13% to 21%. Similar growth trajectory can investors expect even going forward?
See, we are talking because of the COVID year, we are talking about the lower base. But if you see, return on capital for the last 5 years is around 23%. I think that's a better way of taking the numbers because of the COVID year, there was a depression in one particular year. So we expect that the ROCEs will be upwards of these numbers going forward as well. And the trajectory and the growth will also be in a similar range if you talk about from a 5-year perspective.
Thank you, sir, for giving us all those details. With that, with that, let's wrap on this edition of Markets at Noon.